Today we're talking about velocity banking as a debt repayment method. So we're going to go over what it is, the pros, the cons of it, and if after watching this video you're still somehow considering this risky strategy that can wipe you out, we'll go over ways how you can mitigate some of the risks so you don't lose it all. Hi, I'm Eva, and I'm the founder of Fierce Rich Money. After 2 years of unemployment, I'm back in debt. Got out of debt before using my plan. I'm doing it again. So this channel's about normal ways of getting out of debt, not the weird and extreme ways that litter the internet. So we will cut through the lies and misinformation being told to us because that's keeping us in the dark and poor. I want to thank the commenter who left a comment asking if the Fierce Rich Money method for debt payoff is the same as velocity banking. It is not. It is totally different. And Fierce Rich Money method, you're paying off debt with money you're earning. So velocity banking is a strategy that focuses on using a line of credit, usually a home equity line of credit, a HELOC, as a tool to pay off your mortgage faster, reduce interest rates, and improve cash flow. It relies on optimizing cash flow, leveraging credit wisely, and paying down debt strategically. Sounds good so far, right? So here's an overview of how it works. So you use usually a HELOC, which is a home equity line of credit or some other line of credit, but it's usually that because most people have equity in their home. And it's typically you borrow money at a lower rate than your mortgage. And the HELOC allows you to borrow against the equity in your home. You then deposit all your income into the HELOC instead of putting your paycheck into a checking account. You deposit all the income there, and that immediately reduces your debt or its balance by minimizing the interest owed. You pay your expenses from that HELOC, so as expenses arise, you use the HELOC to cover them. But since your income has reduced the outstanding balance, you've effectively reduced the amount of interest and interest charges on both the HELOCs and your mortgage. All right, you with me so far? You can make lump sum mortgage payments, which will lower your mortgage, and you can put the money towards principal. So you pay off your mortgage faster than traditional monthly payments. All right, you with me so far? All right, what are the pros? Fast mortgage payoff. Making larger payments towards your mortgage principal can reduce your mortgage term significantly by saving thousands in interest. It minimizes interest on debt. The HELOCs typically have lower interest rates than most mortgages, and by cycling your income through it, you reduce the outstanding balance and the interest charges on your debt. All right. Flexibility in cash flow. Since the HELOC is a revolving line of credit, it provides flexibility. You can borrow against it as needed, giving you access to cash without having to refinance your home or take out additional loans. Number 4, it leverages idle income. So it encourages you to use your income more efficiently. So instead of keeping the money in a low interest savings account, you can use it to reduce your debt balance, which minimizes interest charges. All right. Number 5, it's a debt payoff strategy beyond the mortgage. And although it's usually used for mortgage payoff, velocity banking can also be used to pay down other high interest debts like credit cards or auto loans. All right, let's go over the cons, and there are lots of them. All right, variable interest rates on HELOCs. So the risk is most home equity lines of credit, which are central to the velocity banking strategy, they come with variable interest rates. So that means if interest rates rise, your monthly payments on the HELOC will also rise, increasing it, making it more expensive to maintain. The impact: a sudden increase in interest rates can lead to higher overall debt costs, reducing the effectiveness of this strategy and possibly leading to financial strain. Over leveraging. The risk: this strategy relies heavily on borrowing through the HELOC, which is secured by your home. If you don't manage the debt responsibly or accumulate more debt than you can handle, you can over leverage. And what's that impact? If you can't repay the HELOC, you risk losing your home because that's your collateral, all right? Over-reliance on credit can lead to financial instability, especially if your income fluctuates and unexpected expenses arise. Income volatility. So this works best. Velocity banking works best when you have a consistent, predictable income. Any disruption in cash flow, such as a job loss, a pay cut, or medical emergency, could make it difficult to meet your payment obligation on both the HELOCs and your regular living expenses. So the impact: if your income decreases and you're unable to keep up with your payments, it can lead to more debt or even foreclosure if you default on that HELOC. Requires strong financial discipline, right? So the risk is it demands careful budgeting and spending discipline. Since you're using a line of credit for your everyday expenses and to pay down debt, any mismanagement, such as overpaying, overspending, or failing to make regular payments, will lead to more debt. The impact: if you're not disciplined about paying down your HELOC or maintaining cash flow, you can fall deeper into debt, and instead of improving your financial situation, you've lost your home. Closing costs and fees. So these come with various fees, including application fees, appraisal fees, closing cost fees. And in some cases, those annual fees and penalties, if you pay off early, you get penalized for paying it off early. Think about that. Like, the impact is add these fees up, and it can reduce the financial benefit of this strategy, making it even less cost effective. If the fees outweigh the savings from paying off your mortgage faster, the risk may not be worth it. Potential negative equity. So the risk is, by using a HELOC to pay off your mortgage, you're reducing your home equity, which is the portion of your home you truly own. And if your property value drops or the housing market crashes, which happens, we know this, you can end up owing more money on your home than it's worth, and you've got an underwater mortgage. So the impact is negative equity makes it harder to sell or refinance your home, and you can find yourself in a horrible financial situation where you may need to sell quickly. Complexity of execution. Look, let's face it, it is like a complex strategy requiring a good understanding of how interest, cash flow, and credit lines work. One small miscalculation or misunderstanding can lead to huge costly mistakes, such as drawing too much from the HELOCs and not accounting for variable interest rates. So the impact is, if you don't fully understand the nuances of this strategy or make an error, you may not realize the anticipated benefits and could end up in a worse financial position. Number 6, access to a HELOC isn't always guaranteed. To qualify for one, you generally need a good credit score and enough equity in your home. And if you don't meet these criteria, this strategy is not an option. All right, so we went over the risks. The 3 main ones are fluctuating income. If you have an irregular or unpredictable income, the strategy is unsustainable for you to rely on that steady cash flow to reduce debt. Rising interest rates, that can happen, and your HELOC rates can jump making your debt repayment even more expensive. Increased debt load. If you use a HELOC for non-essential purchases, or fail to control your spending, you can increase your debt rather than reduce it. So, how do we manage, or how do you manage these mitigating risks? One, you got to find a fixed rate if possible, to avoid the variable interest rate fluctuations. Number two, you need to maintain a solid emergency fund to cover living expenses or unexpected costs, so you don't need to rely entirely on the HELOC. Number three, disciplined budgeting. You need to stick to a budget to ensure you're using the HELOC primarily for debt payoff and not unnecessary spending. Four, monitor interest rates. Stay informed about potential changes of interest rates, because if you weren't able to get a fixed rate, you got to keep an eye on that, and you need to adjust your strategy as needed. Financial planning. Work with a financial advisor to ensure you understand the risks and benefits of velocity banking and whether it will align with your financial goals. All right, look, velocity banking is a risky strategy if you're not prepared to manage the complexities, deal with the variable interest rates, and maintain strict control over your budget and spending. Look, it works best for people with a stable income, excellent credit, and a disciplined approach to finances. If any of these elements are lacking, the risks outweigh the potential benefits. All right. Also remember, everyone's financial journey is unique, so it's essential to create a personalized plan that works for you, because that's how you stay motivated and focused. All right. So that's velocity banking, the Fierce Rich Money method of debt payoff. Totally different. I'll link the video for that in this one, and that's it. So if you're considering it, please read up on it, ask questions, okay? So I hope you found this of value, and I will see you in the next one.